Jennifer Serrain, you're looking at Amex shares currently off by 3.5%. You take a look at the broader market right now. The S&P 500 still hanging on to gains here, up 0.2%. Not too much to look at. It looks like we're going to end this week though on a positive note, Scarlett.
Yeah, it's for the S&P and the Dow in particular, which is up 2.3%. But guess what? The Nasdaq going to end the week with losses if things hold out the way they are.
Yeah, so we'll see. We have about 90 minutes left. We'll see how this week ends up. Don't go anywhere. This is Bloomberg.
I don't think we can replicate Tesla. Tesla is a unique because when they founded and then the personality behind it, the product is beautiful, technologically very, very strong. So in many areas, Tesla is Tesla, but Xpeng is Xpeng. We want to focus on what we think is important for our customers. Our customer like beautifully designed vehicles, either it's large SUV or sports sedan. We believe we have a very, very appealing family look that our customers is really attracted to. They like to have user-friendly features inside the cabin that has a technology feel. It's very smart. It enables them to really utilize the vehicle that's different.
Bloomberg UK, your source for news and analysis covering the biggest challenges facing the UK government, economy, financial services and markets.
Tax cuts should not be the priority. It's about a credible plan for growth over the next 2-3 years.
In this post-Brexit world, how do you see actually servicing your clients?
It was disruptive, and it's going to have implications to how capital raising works.
Now we're having the perfect storm in the UK.
Watch Francine Lacqua Thursdays at 9:30 a.m. only on Bloomberg, your global business authority.
This is Bloomberg Markets, the close. Let's get a cross-asset check as we head towards the close of commodities trading. Bloomberg's Abigail Doolittle has more. Hey, Abigail.
Hey, Scarlett. Well, right now we are looking at some mixed moves here for some of the major commodities we followed. Oil, New York crude, WTI up 1.9%, despite the fact, and this is impressive, that you have the Bloomberg Dollar Index up a fourth day in a row. Typically, you would see commodities overall drop on that, but we see a nice gain for oil. Lumber had been higher, but now it's up just slightly. Wheat, on the other hand, down 4.2%. This, of course, after surging earlier this week on concerns around angst between Ukraine, more than angst, between Ukraine and Russia, and the idea that supplies could be cut off. And then natural gas, well, we've had a big rally there on all this hot weather, but at this point, we do have natural gas taking a little bit of a breather, down 1.4%. Maybe that means some slightly cooler weather could be ahead. That wouldn't be such a bad thing here, at least in New York. Now, relative to commodities on the week, they are higher, and something technically interesting is happening. This is a one-year chart of the Bloomberg Commodity Index, and you can see that for the most part, this downtrend has really held quite well. One exception last summer, where you can see the Bloomberg Commodity Index broke out of this range just a little bit. Well, right now, Scarlett, we're looking at a little bit of a breakout to the upside too, maybe going toward the 200-day moving average. The big question is, will this strength persist, or are we going to go back down into that range? Given the fact that the dollar is higher, I think the dollar is going to be the one to watch. If it continues to go higher, then we might see the Bloomberg Commodity Index do what happened last summer.
Yeah, the dollar is certainly a driver. Also a driver is potentially the weather. So let's link the two here and focus on how commodities are being affected by the global heat wave. Joining us now is Jim Romer. He's president of Best Weather and co-founder of Climate Predict. Jim advises hedge funds, farmers, and commodity traders on the impact of weather on the markets. Jim, it's great to speak with you. I want to start with the soft commodities. Abigail mentioned wheat and, of course, the geopolitics there. But geopolitics aside, how is the weather affecting the wheat market?
Well, wheat is a grain commodity, actually, not a soft commodity. But
a grain commodity, you said?
Wheat, corn, soybeans, and wheat are grains, and cocoa, coffee, sugar. Those markets are actually soft commodities. So the wheat market exploded, obviously, in these Russian tensions and restriction of exports out of the Ukraine. But also, we have one of the worst droughts in 100 years in Canada. That does not usually happen with an El Nino. What's going on right now, the planet is just so warm, the warmest the oceans have been in 10,000 years. El Nino aside, we are seeing droughts over in China, the Midwest, the Canadian prairies, and this is affecting a lot of the grain markets right now.
So when you talk to farmers, how do you advise them? What questions are they asking you in terms of how they prepare for this?
So I have a newsletter called Weather Wealth, actually. It goes out to farmers and traders around the world on my website. And they're all asking, do I buy puts? Do I sell calls? How do I use the weather right now to take advantage of these near record high prices? Well, about a third to half the Corn Belt's in a drought. The other half of the Midwest is actually getting a lot of rain right now. So we're seeing a lot of volatility. And the way to do that, the way to hedge risk and to advise farmers is to sell calls and puts. That's called actually a strangle. It's very, very complicated. But for the most part, this drought in the Midwest, about half of it is actually easing. The other half is not. It makes it very, very volatile. With El Nino coming on over the course of the next 6 months, getting stronger, typically you see bear markets in grain. So as we go into the South American summer or winter, I would expect we could probably see lower grain prices. I'm telling most farmers to be hedging some of their crop at these higher prices right now.
So you have geopolitics, then you also have weather in the form of El Nino coming to the grain markets. But I want to talk about the extreme heat that we're seeing right now. And Jim, something I've been wondering is, what's the first order effect on the commodities markets? Does that hit agriculture first, or is that more going to be expressed in the energy markets?
Well, we just saw natural gas prices finally break out, which we've been telling some clients here in my newsletter the last week or so. Phoenix, for example, they don't really consume a lot of natural gas down there, but they had 30 straight days over 100 degrees, and some of those 90s and 100 degrees are going into Texas, the Midwest, and it's beginning to sap into some of the supplies right now. So we could see natural gas prices rally another 15% if August is hot, which I think it will. The Northeast is going to have a cool spell in about 10 to 15 days. Otherwise, natural gas prices could explode. So natural gas rig counts are coming down right now. The charts look more positive, and this heat is beginning to take its toll, certainly on some of the production.
And Jim, maybe this is a silly question, but when we're talking about weather and all the different extremes, and then you mentioned, the cold snap coming to the Northeast, I'm looking forward to that. Are there any commodity markets that are sort of immune to these forces?
Well, right now, I would say, no, in the ag sector, almost everyone is somehow being affected by either El Nino or these record warm temperatures from, I believe, somewhat climate change. For example, along the equator right now, in the tropics, it's really wet in West Africa. This is supposed to be their dry season coming up. The warm oceans are producing heavy rain and disease issues, and cocoa prices are surging right now. Also, sugar. Thailand's the number 3 biggest producer of sugar in the world. They're having a drought. The only real areas I see that are benefiting right now from from all this warm weather and also El Nino is India's monsoon that typically could actually have a lot of problems, and that would set markets like cotton and sugar soaring. Actually is going to get some rain. So from the soft commodity perspective right now, it's mostly cocoa and cotton in China and Texas and also West Africa. They're seeing the effects of both climate change and also El Nino, and I think we'll stay in bull markets, actually.
Okay, it's not going to be hot forever. At some point, the weather will turn, and as Katie looks ahead to that cold snap, how does this set us up for later on this year, for the end of the year, during the winter of the Northern Hemisphere?
You know, we're overdue for a really cold winter, but 70% of all El Nino years typically have warmer than normal winters. So we may get a spike in natural gas here with incredible demand in the southern half, the 2/3 of the country, the next few weeks. Maybe go back to $3, $3.20. And then if we have a warm winter, we could go right back down into the $2 area again. So very volatile markets right now. The way to trade a lot of this with this extreme crazy weather is, again, really using options. I think I'm most bullish right now, probably cocoa, cotton crops are just dying, you know, in Texas, or they're going to probably over the next month. It was 125 degrees in parts of China, never seen in several thousand years this week. Cotton crop's going to be hurt there too. So a lot of the soft commodities, I think, will get the most bullish impact of this, and possibly also canola in Canada and spring wheat, where the drought will continue to exacerbate here over the next few weeks.
Jim, really enjoyed this. Hope to catch up with you soon. That is Jim Romer. He is president of Best Weather and co-founder of Climate Predict.
I had no idea grain was not a soft commodity. I thought automatically anything that wasn't energy just fell into the soft commodities patch.
And I gotta say, I don't often think about cocoa, so now I am.
You don't eat enough chocolate then?
Apparently not. No, not a huge chocolate fan. Really fascinating though. Excited to catch up with Jim after. Hopefully we do get that cold snap. We'll see. But still ahead on this program before we get there. American Airlines shares wavering now after its lackluster third quarter outlook didn't sit well with investors, especially compared to its peers. More on how it could spur concerns about the domestic market. This is Bloomberg.
Welcome to the world of decentralized finance.
You can see the massive gains for the OG crypto coin.
Breakout we have all perhaps long awaited, finally realized. We'll see if it sticks.
Bloomberg's covering all things crypto, the people,
There's no question this industry is composed of some bad actors and some good actors.
the transactions,
Volumes have surpassed $24 billion per day.
and the technology.
Stop talking about the technology, start demonstrating the utility.
Bloomberg Crypto, Tuesdays.
DOJ or other authorities.
Could face bigger challenges.
Listens next.
It was going to keep rate wild caught. This is a 3.
As the economic picture does. The OK is getting ready to make a decision.
Have you thought maybe I should go do something else? I can't do anything better than I'm already doing. I already turned this company around. I've made a lot of money for the investors, the shareholders, and yourself. Are you happy doing this? You're going to do this for the foreseeable future?
I'm going to do it for the foreseeable future. I love what I do, and the reality is we've accomplished a lot. As you described, we've made Blackstone a lot of money. We made our shareholders a lot of money. More importantly, we've grown the business, and we've been a huge engine of opportunity. If you think about all the jobs we've created around the world, all the communities we've made better places, all the ownership groups who we've helped grow their business, and having built a world-class culture, the opportunities we've created for upward mobility for people. And this business, I would still say, is like a coiled spring coming out of COVID particularly. So I feel like we just have more to do. My job's far from done.
Moment news break stocks. No one covers the world like Bloomberg.
The word here continues to be, let's stand with Ukraine, quote, support Ukraine so they can win militarily and obtain their objectives on the battlefield.
For Taiwanese stocks in the first half, 30% up from the lows that we saw last year. It's really been driven by this whole AI semi sort of trade here.
The $69 billion deal was the biggest video games deal, but it's also pretty much the biggest technology M&A. Makes it pretty exciting here.
Bloomberg, your global business authority.
Time now for top calls. Look at some of the big movers on the back of analyst recommendations. And we start with Harley Davidson. The motorcycle maker upgraded to buy from neutral over at DA Davidson. Analysts there say that industry checks revealed better than feared U.S. retail and inventory levels, suggesting that the stock will exceed low expectations when it posts earnings next week. Shares higher to the tune of 2.4%. Next up, we have Herc Holdings. It took a double downgrade over at Bank of America. It had its rating cut to underperform, and its price target also ticked down to $140 from $150. Now, the analyst there believes that things look muddy, if you will, for the equipment rental company, which could take a minor hit in sales from the strikes in Hollywood. Shares currently off by about 6% or so. And I want to end with Knight Swift Transportation. It was cut to inline from outperform over at Evercore after posting second quarter results that missed street estimates. The analyst says that the kitchen sink guidance, their words, has exposed the true downside risk, and that the new starting point for a cyclical recovery is so low that a much more ambitious demand rebound is needed to warrant the current share price. Take a look at the shares, though, pretty much unchanged, currently about 0.1% higher. And those are some of our top calls. Let's pivot now to air travel, where, of course, investors are lukewarm on American Airlines after it posted weaker than expected revenue guidance for the third quarter. And this was despite solid second quarter results out Thursday that beat estimates. So for more on a broader outlook at carriers, let's bring in Savathi Saith. She is managing director over at Raymond James. And so walk us through a little bit more what we heard from American Airlines. A beat, but it sounds like the outlook was disappointing.
They sounded really good, actually, in the sense of they're talking about demand being strong, and you've heard this consistently across the airlines that where investors are trying to kind of wade through a bunch of different cross currents, and they're worried about domestic demand rolling over. And the commentary there is the demand is really strong. It's just that you have some very tough comps. On the flip side, in the international market, not only are you seeing demand recover, I think there's a little bit of a supply shortage, and therefore fares are also very, very high, maybe similar to what we saw last year in the domestic market is what we're seeing in the international market. And American has less exposure to that. So I think it's a combination of, demand is strong, but maybe not as strong as we thought on the domestic side, not bad, but not as strong. And the international is really strong, but American having less exposure to that.
Yeah, and I mean, is that similar to what we heard from Delta and United? While American maybe doesn't have as much international exposure, did we hear a similar dynamic where demand domestically is a little bit softer, especially compared to what we're seeing overseas?
Exactly. And again, if you ask them, they characterize it as demand is being strong, but the comps are tough. And in an environment where investors are looking for any sign of weakness ahead of, recession or pent-up demand fading away, seeing kind of year-over-year declines in unit revenue or fares is kind of disconcerting. So I think there's a kind of a mixed message of airlines saying demand is strong, staying healthy, and investors just worrying that things are rolling over.
I wonder, Savathi, are airline CEOs more likely to be aggressive or conservative in offering guidance for the coming quarters, given where we are with the economy right now?
Yeah, I mean, each one is a little bit different in their approach. What I would say is airline CEOs have limited visibility In the international markets, you might have a little bit more visibility out into October timeframe because leisure is still driving that. In the summer, you have some visibility because it is driven by leisure. But as you get into the fall, it's a lot more dependent on business demand and that close-in purchasing. So there's very limited visibility, and that's why I think investors aren't putting a lot of weight to what they're hearing from CEOs, because we all need to wait till late August, early September to really get a sense of, what does the demand environment, especially in the domestic market, look like.
Right. And things are still normalizing when it comes to business travel as well. We haven't really seen a normal business travel environment since before the pandemic. JetBlue, of course, had this Northeast Alliance with American Airlines, and they've had to wind it down because of the DOJ's opposition to it. What kind of material impact will that have on AAL?
We think it's not good. Now, American says there are a lot of things that caused them to do that partnership back in kind of 2019, 2020 timeframe when they were talking about it. That doesn't exist today, so they are not worried about an impact. We're a little bit more circumspect, and we think, when demand is strong in the peak summer leisure timeframe, you're not going to see it. But as you get into the fall, I think there will be, pressure from not having that partnership, not feeding those flights from New York for Americans. So we're a little bit more circumspect on what kind of an impact that can have.
Right.
Not big, but on the margin, it should show up.
Got it. Savanthi, really appreciate your joining us, giving us your take on American Airlines. Savanthi Syth, I should say, of Raymond James. Now, coming up, the two letters of the alphabet responsible for a big chunk of the NASDAQ's run this year, AI. Larry Summers, former U.S. Treasury Secretary, and Steve Ratner, the former chief advisor on the auto industry at Treasury, tell us what generative AI could mean for investors. This is Bloomberg.
Is crucially important, and I think we've moved from this attitude from it's an indulgence, a waste of time, almost an illness that needs a cure.
For something as universally important to human life as sleep, mysteries surrounding its necessity and utility have only just been recently uncovered.
Some of our biggest discoveries were in the 1970s or 1980s, and so it makes it a really exciting field because it seems as though we're uncovering new insights each and every day.
Some scientists are going further to find out how sleep and what happens there can be harnessed to further expand our understanding.
It's easy to memorize things. That makes you smart if you can spit back a lot of facts. But if you want to be wise, if you really want wisdom, you've got to know when and how and why to use that information. And that's what your brain figures out while you're sleeping.
Bloomberg covers the world with unmatched reach and resources. From more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, your global business authority.
Wall Street Week Daily segment, Bloomberg's David Weston spoke with Larry Summers, the former U.S. Treasury Secretary, and Steve Ratner, the CEO of Willett Advisors, to discuss the changes that we'll all experience with AI, as well as some of the consequences, too.
I think there are two things that have to be added to the AI conversation. The first is that technological change really does have some major distributional and opportunity consequences. When I was first exposed to these arguments as an undergraduate student at MIT in the early 1970s, there were people explaining about how terrible automation was going to be. And then there were the smart people, for me at that time, personified by Nobel Prize winner Robert Solow, explaining that ultimately things evolved and new jobs were created, and this was progress. And it's all right, just one thing. In the 1960s, 96% of American men 25 to 54 were working, and only 4% were not. Today, it's more like 14% who are not working.
Are there things we should be doing right now that we fail to do with automation and with globalization to think about those distributional effects, potentially of AI, to make sure that we bring more people along with the progress?
Absolutely. Look, I don't think actually Larry and I really disagree. I understand the problem he's talking about. It actually relates to automation a lot and also to trade, and where I think, frankly, the economists, and Larry may jump down my throat for this, but where I think the economists got it wrong on trade, which is similar in a lot of respects to automation or other technological improvements in terms of its impact, is that trade had huge macroeconomic benefits for the country. We missed the microeconomic impacts. Those workers in Flint or Detroit or in Ohio, some of their jobs were, and I actually just read something the other day, rough justice, maybe half their jobs were lost to automation, the other half were lost to trade. And we had this little trade adjustment assistance program which basically did nothing. And we have not really done a great job as a society, both in getting the benefits of technology into the hands of everybody. There's been this lack of wage growth commensurate with the productivity growth over a fairly long period of time now, as well as individuals and finding them things to do where they can be more productive and happier.
Larry, what about it? Did the economists, and yes, the policymaker in Washington, it sort of let us all down with respect to both automation and trade?
We should have done more to cushion the various changes associated with trade. I agree with that. I'm not sure I agree with Steve's quantification. And I think that a full calculus on trade has to recognize a large number of benefits in terms of jobs created and in terms of real wages enhanced. But that brings me to the other point I wanted to make about AI. And I don't know for sure about this, but if my suspicion is right, it's very big. Most of the technological changes we've had before came for working people doing relatively routine things. They were automatic ways of picking cotton that came from agricultural workers. They were things that replaced typists or telephone operators, as Steve mentioned. I have a suspicion that AI is coming for the cognitive class. And part of the reason you're seeing such hysteria now is that it's the people who write articles and their friends, the people like the three of us, who are more at risk from AI competition than has been the case with most of the technological innovations in the past. I would say that there's a substantial chance that AI is going to be much more of a threat to IQ than it is to EQ. It will be a very long time before AI will replace many of the kinds of direct physical work. Think of working in a garden, for example. So I have a suspicion that the distributional consequences of AI for the bosses versus the bossed may be very different than the distributional consequences of many of the other technological revolutions, and that affects how bosses are going to think about it in profound ways. They're going to be much more scared, and on the other side, it may be more benign from the point of view of some of those who've been traditionally left behind.
So, Larry, I agree with that. I think it is the cognitive classes, as you call them, who are most at risk. I might make it this. I'm not sure I would think about it as bosses and boss, but I will use this historical analogy to give us a little bit of hope. When I started on Wall Street as a young investment banker, I had nothing. I had an early HP-12C calculator in my hand. We had no Excel. We had no computers to speak of. We had no nothing. All of our spreadsheets were done by hand. They took a really long time. They had to then be typed up. We'll put the typists aside, and then if I wanted to make a change, I had to start all over again. And now that can all be done with the click of a mouse with an Excel program by anybody with a small personal computer. And yet the number of people doing what I did 40 years ago when I started on Wall Street has multiplied since then. And so it became a productivity enhancing tool, not a job destructive tool. I'm perfectly prepared to believe that this may come out a different way. All I'm saying is I don't think we know yet, and I think history is probably still on the side that we will find our way through this in a positive way.
That was Larry Summers, former U.S. Treasury Secretary, and Steve Ratner, Willett Advisors CEO. And on Wall Street Week tonight, Bloomberg's David Weston will be joined by Dennis Arfa, Artist Group International founder, Owen Thomas, Boston Properties CEO, and more. That will be 6 p.m. tonight, New York time. Still ahead on the close, more on the markets, and you're looking at the S&P 500, trying to hang on to gains here, currently about 0.2% higher. You take a look at the NASDAQ 100, fighting into the green. We'll see if it can hold it about unchanged right now. Of course, that follows its worst day since February yesterday, a fall of 2.3% after some disappointing earnings from Tesla, from Netflix. The NASDAQ 100, the big tech benchmark, currently lower on the week. It's going to take a lot in the next hour.
This is Bloomberg Business Week. Insight from the reporters and editors who bring you America's most trusted business magazine, plus global business, finance, and tech news as it happens. Bloomberg Business Week with Carol Masser and Tim Stenevec on Bloomberg Radio.
And very happy Friday, everyone. It is Barbenheimer Friday.
I was in a good mood until Joe Matthew put that song on. That is like one of the worst songs ever written.
Come back to me. Come back to me. We got 3 hours.
They won't even play it in Ibiza. It's that bad.
All right, guys. Welcome. It is the Friday edition of Bloomberg Business Week. Friday, July 21st. Got the day and the date right.
Third day in a row.
I'm wearing pink. You kind of have a reddish, pinkish tie, it looks like.
I've already got my tickets, though.
I don't have my tickets yet.
For Barbie at the Alamo tonight.
Nicely done.
Yeah.
All right, so Matt's going to go to Barbie. We know what his plans are. I'm Carol Masser, along with Matt Miller, in for Tim. We're going to talk about the markets trade. We've got the Dow on track to be up 10 in a row. I mean, kind of what's up with that and what that means. We'll talk about the trade. We're going to talk a little bit about bank stocks.
The Dow.
I know.
The Dow? You're talking about the Dow Jones Industrial Average?
Remember that sweet little index?
Yeah.
That we used to talk about a lot and then kind of got away from it?
Wow.
Yeah. All right, guys. I don't know what it means.
Flashback to the days of old.
I don't know what it means. So we're going to talk about that. We're going to talk about bank stocks. You had a great guest on TV, and you said, we got to bring this individual on with us.
Yeah, she is really smart. And she doesn't just cover bank stocks at Moody's. She also covers increasingly more private credit.
You know, you got me in on that. You had me at hello, and you had me at private credit. All right, we're talking about climate change, guys. You all know it. Around the world, around the country, intense heat that we're seeing, extreme heat. We're going to get into kind of why this is happening. There's some global weather factors at play as a result of climate change.
We're almost done talking about climate change, right?
Matt, we're not done. We're just at the
because
beginning.
it's like we're going to talk about gravity today. You know,
talk about gravity.
It's just a fact of life now that we have to live with.
Yeah, you know, for all you naysayers, 10 years ago, 15 years ago, welcome to reality. We're going to talk about presidential politics. We're also going to talk about the wonder drugs that are being used by celebrities and others to lose weight. It's the cover story of Bloomberg Business Week, the Weight Watchers strategy, but we're going to get a medical perspective, which I am looking forward to.
Me too. I have so many questions.
Do you really?
How soon can I start taking it? How long do I have to take it? How is it going to affect me later in life? Will I mutate?
Are you taking it?
Not yet.
All right. So Matt's got his laundry list, guys. Montage International, their founder, chairman, and CEO. We're going to talk about luxury travel. And then what Matt Miller is driving.
Oh, speaking of luxury,
Da-da-da.
Very luxurious.
Stay tuned. Countdown to the close, though, starts right now.
Countdown to the close. Bloomberg's comprehensive cross-platform coverage ahead of the U.S. market close starts right now.
This is the Countdown to the Close. I'm Scarlett Fu here with Katie Greifeld, and we now welcome our colleagues Carol Masser and Matt Miller. And together, we welcome all of our Bloomberg audiences across our different platforms, TV, radio, YouTube, and originals. Are we missing anyone here?
Metaverse. We are everywhere.
It's like 10 platforms.
Yeah. Just, we're also,
and always growing.
Maybe we're in the Barbie dream house.
I would like to be.
We're going to talk about that.
There's a lot of pink shades here.
Yeah, come on, right? Yeah. Like we kind of did the pink
Even
rainbow.
Matt got in on it.
The gamut.
It's kind of reddish, but it works, right? All right, we're going to talk about Barbie in just a moment. Let's talk about, man, all those economists, right, who were like, recession for the last year and a half, 2 years. So many of them are rethinking that. It's the most read story on the Bloomberg. We're talking about the folks over at Deutsche Bank, Nomura. What's interesting is Bloomberg, too, also did a survey. They say that there's still a 60% chance that the U.S. falls into recession in the next 12 months. And this is despite kind of upping forecasts when it comes to GDP for the second and third quarters. But nonetheless, a lot of economists saying, Matt, what recession? Soft landing. Well, how about a soft landing, everybody?
It's true. And strategists, we should point out.
Yes.
You know, just a couple of days ago, Marko Kolanovic came out and said chances of a soft landing are rising, and he turned bearish at the end of 2022.
I think, Katie, what you said earlier was really prescient, which is maybe this is what a soft landing looks like. Maybe we're in the middle of it. It's just that no one wants to admit that this could be it because you never know. There could be something that takes us lower.
Is this like Barbie realizing that her foot is flat?
Oh, my God. I haven't seen the movie yet. Don't spoil it.
None of us have seen the movie.
Haven't
I thought
you
the
seen
idea
the
is that her foot is not flat.
No, but it then goes flat.
Oh.
Wow.
Right.
Wow. Spoiler.
Spoiler.
I would trust Carol over Matt on this.
Yeah, Carol does have on pink, so I would trust you on Barbie.
And she loves to wear heels.
Can we talk
and
about...
I don't as much.
As much.
No, I've seen you around the newsroom. No, I'm just kidding. All right.
In any case, let's talk about Barbie, Barbenheimer, if you will, because we have Barbie, we have Oppenheimer coming out. And if you look at the box office expectations, this is by far expected to be the busiest weekend of 2023. According to Box Office Pro forecasts, we could bring in well over $200 million this weekend. That would be one of the busiest for theaters since the pandemic. The breakdown's really interesting because pre-release sales for Barbie suggest it could bring in anywhere from $140 to $175 million, while Oppenheimer projected to bring in near 50, pretty much half, $50 to $70 million, partly due to limited screenings, rather, and I didn't realize it has a 3-hour runtime. That
the limited screenings release excuse.
I mean, not just that, but since it's a Christopher Nolan movie, you won't be able to hear about half the dialogue. So no one's going to know exactly. That's just what he does. That's like part of his thing, so that you can interpret the movie however you like, since you don't know what anyone said.
And part of the thing, too, for this weekend is that people are going to watch both movies. It's like a double billing. They're going to spend the entire day in the movie theater, given that Oppenheimer's 3 hours.
Which do you see first? Do you see Oppenheimer first, or do you see Barbie first?
Oppenheimer.
Oppenheimer first.
Totally.
Yeah.
Okay, you get the 3 hours out of the way?
Totally.
Yeah.
Do you guys remember the days where you would pay for one movie, go into the theater, and then sneak the second one in?
I used to do that a lot.
See, I knew one of you would do it. Yep.
It's interesting. Just go back to the markets. Mattel, Barbie, up about 0.6%. AMC, which I think the company's CEO tweeted that 60,000 of the movie theater chain's Stubbs members have bought same-day double feature tickets. For both AMC's up about 1%.
Even the team at Citadel has been enjoying the AMC theater chain lately. Yeah.
You think so?
Yeah, they tweeted out or wrote a blog post that they had such a great time at the movies, and it turned out to be an AMC theater.
Are those interns that are making like $1 million this summer? Yeah, they can afford it. All right, guys, we're going to be back in less than an hour's time. We're going to wrap you up the trading for the day and, of course, the week, our cross-platform on radio, TV, YouTube, and Bloomberg Originals. We'll see you at 4 p.m. Wall Street time.
Queen the music.
Whenever my
it's
Barbie
pretty
head.
good. I mean, I listened to it.
That was a great movie too.
I listened to it so much in middle school that I'm kind of over. You know how Led Zeppelin.
Remember
I
when the
love,
basketball team would be warming up and they would
so
play
much.
"We Are the Champions"?
Yeah, I think they still do that.
We would all be doing that. Okay, all right. Let's talk about the markets. What are the champions? What are the nots? What are not maybe in this week's trade? I feel like there's a lot coming up next week, Matt. We've got the FOMC meeting. We've got several central banks meeting, and then of course you've got some big tech earnings next week. So I feel like there's going to be a lot that can shape the trade.
Absolutely, and we still have. It's not all about earnings. We still have economic data that's going to keep pouring out from the PMIs that are going to be key next week to more housing data. So there's a lot to follow along with.
All right, so let's get to it. And you mentioned strategists who are continuing to kick up their S&P forecasts. Bloomberg News economics editor Molly Smith is with us on the phone in New York City. Bloomberg Intelligence chief equity strategist Gina Martin-Adams with us on Zoom in New Jersey. Gina, I do kind of want to start with you, though, in terms of the earnings flow, how that's playing out, and what you're seeing in terms of the equity trade reaction.
Yeah, it's been a really interesting earnings season so far. Only about a fifth of companies have reported in the index. Most of those are financials. We're about a third of the way through the financials reporting season. The net result of every of the reports so far is that earnings are largely tracking a bit better than expected. Instead of down about 9%, they're down about 8.5% year over year, and that is including all the companies that have reported as well as those companies that have yet to report.
So we're down, but not as down as much as everyone thought.
Yeah, it's very early, and the price reactions data, frankly, is really bizarre. When you look at the average price reaction, it's much worse than average across the board, to a beat, to a miss, to whatever it is, which would suggest it's just too early to draw a ton of conclusions. And the companies that missed on both the bottom and top line were actually up more than the market. So there's just a lot of confusion so far. I think it's just too early to draw a ton of conclusions.
So when are we going to know? What are the sort of bellwether reports that you're looking forward to?
Yeah, well, next week you get 40% of the market cap of the index reporting. So by the end of next week, we'll go from 20% having reported to 60%. So we'll get a ton of context next week. Obviously, the highest expectations are in the market are for the largest stocks in the market as well as tech. And we get a lot of those next week, including Microsoft and Google, which I think will be two of the most interesting companies to watch. Sorry, Alphabet. I'm showing my age there.
Nah,
Nonetheless, nonetheless, I think those will be two of the most interesting companies to report. You know, Microsoft in particular is trading at a really big premium, has a potential dollar tailwind that not a lot of people are talking about, but also has a lot of AI risk and a lot of optimistic sort of sentiment embedded in that price. So we'll see how they can contend with those expectations.
Yeah, we've got a guest coming up before the close that is keeping his eye on the dollar and thinks that is certainly important, especially when it comes to kind of earnings and those companies that, U.S. companies that sell overseas. Molly Smith, come on in. FOMC meeting July 26th, pretty much a done deal in terms of a quarter-point hike?
That's the expectation, Carol. Yeah, I can't really imagine anything that would happen between now and then that would derail that. Of course, famous last words there, but really it would be the shock of the century if something threw that off base. The week does get a little bit more interesting data-wise after Wednesday when the Fed meets. We'll get a first look at second quarter GDP. And then on Friday, one of the Fed's favorite wage measures comes out, that employment cost index, also for the second quarter. And we'll get a look at the Fed's favorite inflation measure, the PCE index. So a lot of exciting things Wednesday through Friday coming up next week.
But they're still on track. I mean, the dot plot shows they need to raise 2 more times. And more in the markets, we're hearing investors and strategists say they only expect 1 more hike. We don't get a new dot plot until the end of the year, right?
We'll get another one in September. They come out every quarter. So, I mean, yeah, that especially after we saw that CPI report. Was that last week already, I think? Yeah, I believe it was last week when the time flies here, you know?
Yeah, I
so,
feel ya.
It was when we saw that headline inflation number come in around 3% and, you know, some slowing in the core measure too. I think that really started to ramp up the calls for just July to be one and done as far as the rate hikes go. So still TBD. You're right, Matt, that the dot plot does call for 2 more this year, but we'll see how I think Powell's press conference will be very informative as to how the committee sees the policy path from here.
All right, guys. So I'm looking at a 10-year right now with it's at 3.8. Among our most read on the Bloomberg has to do with Bill Gross, right? Formerly of PIMCO, and he is saying that the bond bull market isn't in the cards, and he says 10-year rates to top 3.5% for a long, long time. Gina, I want to go back to you. How do you project where you think treasuries ultimately land, right? Which you and I talk a lot about, and then in terms of what that means for asset valuations.
I don't. For start, I rely on Ira Jersey and his forecast for where treasuries are headed. He actually thinks that rates are going to fall over the course of the next year in line with what the consensus thinks. But maybe we are past, frankly, the lows of the lows. It's really difficult to imagine we go back to the 2020 levels, 2021 levels on treasuries. I do think that has complications or has consequences at the very least for equities, because it does suggest that sort of your core valuation expectations have to be somewhat restrained. In an environment where rates are higher, you would anticipate the valuations that you're willing to pay for equities across the board are generally lower. And we are seeing that, but not across the board. I mean, what you're seeing in the S&P 500 is a really big divergence between the haves and the have-nots in terms of valuations. The equal weighted index still trading well below pre-pandemic averages you would argue would reflect higher for longer interest rates, whereas the top 5 stocks, top 7 stocks in the index, and the tech sector at large is trading back at record premiums to the rest of the index, and certainly, you know, nowhere near looks to be reflecting higher for longer interest rates. We've got to see then the consequences of that, or you've got to see much, much stronger earnings growth to justify those current valuations, as tech stocks can grow into those expectations via an earnings recovery. But it does create a little bit of volatility or expected volatility around earnings seasons, and certainly at the very least some nervousness around whether or not these stocks can satisfy those high expectations.
Molly, what's your take on the Treasury debate? You know, Ira Jersey and Morgan Stanley are looking for lower yields. I know Matthew Hornbach said 2 to 3% in a recent report, but Bill Dudley, who worked at Goldman Sachs for 20 years, finishing as the chief economist before going on to run the New York Fed, wrote in a Bloomberg opinion column last month that he thinks it's going to 4.5%.
Yeah, there's definitely a lot of different calls out there, higher for lower, lower for longer. I mean, at least just from the Fed's perspective, it looks like we're going to see that Fed funds rate stay at that terminal rate probably through the rest of this year. We just took a survey of economists as to where they see the Fed funds rate among other economic indicators landing over the next couple of years. And looks like the economists are now expecting fewer rate cuts next year from the Fed than they did last month. So it's still very much a toss-up as to where that longer run rate is going to be.
So, Molly, what are you listening for from Jay Powell next week? What's going to be key in your view?
I think it's definitely going to be as much forward guidance as he really can give, which is tough when, you know, the officials have stressed so much how data dependent they are. But a lot of people are, I'm sure, going to be looking for, is that second rate hike really a done deal or not? And where's the committee's thoughts at present of if it's going to be necessary?
And GMA, I guess you're going to be focused on earnings. I mean, I don't expect
GMA.
Powell's not going to change his tune one bit, right? So he's going to be a broken record. Is it earnings your focus?
Yeah, I mean, earnings are going to overwhelm everything in the equity market, I suspect, just given the great, you know, the large swath of companies and how the size of the companies that are reporting. I would say with respect to the Fed, the market now, the equity market, in my opinion, is now more focused on liquidity conditions and what's going on with the lending facility, what's going on with the balance sheet. You know, where is M2 going to head over the course of the next year or so? Sort of the rate discussion is increasingly taking a back seat to those conversations right now. So anything with respect to what are they doing with the balance sheet and what does that really mean for liquidity, I think could trigger an equity market reaction.
Carol kicked off the show talking about the Dow Jones Industrial Average, and Gina Martin Adams is talking about M2 money supply. What year is it?
I don't know. Remember when we used to track money flows too? Oh my God. Everything old is new again. All right, GMA, and of course MS, Molly Smith, Gina Martin Adams, Bloomberg, part of our Bloomberg team here. Gina, of course, with Bloomberg Intelligence, and Molly is Bloomberg News economics editor. Gina, of course, chief equity strategist. Folks, we're just getting started on this Friday.
Just kicking it off.
Yeah. Carol Messer, Matt Miller, this is Bloomberg.
markets, headlines, and breaking news 24 hours a day at Bloomberg.com, on Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
It's 3:21 on Wall Street. We do check markets all day long here at Bloomberg. We are looking at a mixed market right now with the Dow, the S&P. They are both higher, but on the minus side, we have got NASDAQ and the NASDAQ 100 index. Right now, NASDAQ is down 21 points, a drop there of 0.1%. It's the NASDAQ 100 index that is now down by 32 points, a drop there of 0.2%. S&P little changed, up by 0.1%, higher by 4 points. The Dow holding on to a 32-point gain, up by about 0.1%. 10-year yield 3.84%, with a 2-year right now at 4.84%. Spot gold $19.62 the ounce, down $7.50, down by about 0.4%. And West Texas Intermediate crude going to ending the week very close to $77 a barrel, up 1.7% right now, $76.94. So will earnings season be a catalyst for a broadening of the stock market rally, possibly with new highs? Elise Ausenbaugh is global investment strategist at J.P. Morgan Securities. She sees reasons for optimism about the rally.
Our base case does have us trading about sideways between now and 1 year from now. But that bull case is really starting to get more attention amongst investors, because if we zoom out and think about how things have shifted, especially since the spring, the setup is looking more favorable.
And you can hear more of that conversation on the Bloomberg Surveillance podcast. You can download it wherever you get your podcasts. AutoNation's top executive is warning that softening car prices will likely fall further as inventory grows. So this morning, we did hear from AutoNation reporting earnings. The stock now down by 11.4%. And used car retailer Carvana shares down now by 3.5%. I'm Charlie Pellet. That is a Bloomberg Business Flash.
Charlie, thank you so much. Well, U.S. bank stocks have been on a tear this week after a deluge of better-than-feared earnings reports, really bringing investors back to these shares that have really been beaten down.
Better than feared. I saw that expression, and I love it.
It's true, right?
Better than feared. Yeah, I just think it was a nice turn of phrase.
Better than feared. It happens. We're talking about Zion's, Key Corp, the KBW Bank Index, I think up about 7% this week. So let's get into it with more on the group on the public banks, and really the growing role of private lenders, which I truly feel this is the story, I think you do too, of the next 5 to 10 years, and we'll see how it plays out. With us, and really back with Matt, who talked with her yesterday on TV, is Anna Arsov. She's co-head of global banking over at Moody's on Zoom in New York City. Anna, thank you for coming back with us.
I will say, sometimes I have a guest who's so good and insightful that I'm like, we need to get her on again. And this is the case with Anna. So
in less than 24
hours.
Thank
you for coming back. Yeah.
Thank you for having me. It's my pleasure.
Well, let me throw to you, Matt, first, because what was it that stood out for you that you were like, we got to continue this conversation?
Well, I mean, I thought she just had great insight across the board, but one of the things that really got to me was, Carol and I talk about private credit so much, and we're starting to hear more and more about it from bankers who say this is a business, this is kind of getting away from us.
Yeah.
The
was
private,
it Jamie, right? Jamie Dimon, who got a little upset about that private
absolutely.
Folks dancing in
so
the streets?
Tell us about the breakdown, Anna, right now. I mean, It's a juicy business that the big six Wall Street banks are getting less and less of.
Yeah, I mean, I think it's very topical now, I think, for the markets, particularly post-March, when the bank distress started. And of course, folks turned towards the alternative asset managers who have been active in this market, quite since probably even before the financial crisis, but I would say accelerated post-2015. And there's a reason for that. I mean, we all have to remember something called leverage loan guidelines that was implemented by the U.S. regulators, and really tightening that arbitrage by the Fed implementation in 2015 that captured even the foreign banks that were very big in this market, like Deutsche Bank and Credit Suisse, et cetera. And if you look at when that pivotal moment for private credit was, it was exactly a year or so after implementation of those leverage finance guidelines. And why is that the case? Because simply the large banks couldn't put this, 6-7 times very hairy deals on their balance sheet. And what happened? That talent, folks who actually ran the businesses at Goldman, at Credit Suisse, end up going to the private equity shops and said, we can do this business here. And maybe it's a better way to do this business outside of the banks.
So better way, or have we just transferred the risk?
Well, this is the key question. We wrote a number of research questioning the systemic risk here. And I want to be very balanced about this issue. Look, there is the concern is why these loans, which are kind of what would argue one of the weakest quality loans that would be out there in the system, highly levered companies with lots of hair, it's kind of companies that are very levered, but a lot of in the technology sector as well. Why they shouldn't be on banks' balance sheet and what are the benefits of being on banks' balance sheets versus not? Well, let me kind of break that. On banks' balance sheet, at least we will know transparently what are the underwriting. This will be part of the bank reporting. It will be part of the consolidated data for the banking system, and we'll have a little bit better sense how those are faring. And it will be valued under the shared national survey. So we will know actually how those banks are performing, and transparency is pretty much uniform. On the other hand, we don't have that with the private credit lender. So their secret sauce is that we will basically take these loans. We have a permanent capital to underwrite it. And what you can see a lot of the founders of these businesses over the last couple of months, particularly post the bank crisis, they've been talking about, we have permanent capital. We do not depend on overnight deposit and overnight funding. So this is a better form to hold a high-risk asset.
Yeah, it makes a lot more sense. And the duration mismatch problems that we saw upend a couple of banks. Speaking of that, Anna, I've heard more and more analysts say the banking crisis is behind us. It's truly well and done. Do you agree?
And I think I said this yesterday, I'll repeat it again for your audience. What happened in March was very idiosyncratic, exposing vulnerabilities, which I think stem from some lack of consistent regulation in the banking system, of banks who simply had a serious mismatch between assets and liabilities. And when you think about what happened with the speed of quantitative tightening, some were just caught short. Is the banking system outside of that, couple of outliers, solid? Yes, we have a solid and strong banking system. However, it doesn't mean that we're outside the woods. First and foremost, I think this is the best probably quarter we'll see in a while for the regionals. And why is that the case? Well, what we noticed across the board, higher deposit cost. Yes, there was deposit stability, which everybody feared, but that came at a much higher cost. And we calculated today for the banks that reported so far roughly 30 basis points higher deposit cost this quarter for that stability.
So when you look at the banking sector, the big banks, you feel pretty confident about their situation. And then with regionals, you feel like, what would be the adjective to describe them?
Look, what I think it's going to be an interesting year or two ahead. We have a system that's very unusual on a global comparison level. 4,000 plus banks.
It's a lot.
Is
it too many? Is it too many?
Look, one can argue it's all about ability to provide customer differentiation. Community banks do something that's very special for the communities, and likely one can argue maybe community banks should not be as regulated as little complex banks. But what happened was that with deregulation and with the tailoring of 2019, really went beyond the definition of what a community bank is. Community bank is roughly, bank like less than $10, $15 billion. Deregulation affected banks sub 100 to 250 billion. Silicon Valley Bank is not a community bank and basically did not have the same capital standards or LCR standards as some of the larger banks, and one can argue had its own complexity. So is the system ripe for consolidation? I think that will become more obvious as we see pressures on profitability. Now we are seeing it from higher deposit funding, but we will see it now from credit costs coming in due time. So I think consolidation is imminent.
What do you think about the valuations that we're looking at for these banks? I mean, in terms of price to book, 1.1 at Goldman Sachs, 1.6 at JP Morgan, Morgan Stanley's looking at 1.7. Do these make sense? Because Mike Mayo was on the other day and he was so enthusiastic about the fact that he thought the big banks, as a block were undervalued more than he's ever seen them.
Yeah, I mean, I'm coming from a fixed income perspective, but nevertheless, we look at valuations of banks from a more of a definition of the value of the franchise, which is very important to creditors of these banks. And you have to admit that JP Morgan is just, if there was one positive, absolutely clean quarter, that was JP Morgan. That bank, it's a machine in every franchise. And one can argue, what is that, what valuation is appropriate on a relative scale? Morgan Stanley similarly has a great franchise. I mean, they cut costs significantly. They could create some operating leverage, although the capital markets and investment banking earnings were low. And it's again on a very good strategic focus for more than a decade when they decided to buy, the former jewel of Citigroup. So Goldman does not have that, unfortunately. Goldman went into a little bit of experimental focus into consumer that they are retracing back. But Goldman has an amazing asset management business and focus on alternatives. And they reported that fundraising and focus on alternatives actually paying you got good premiums so far. And they're trying to restructure their co-investment portfolio. So they'll be a little bit painful until they get to their targets by next year in terms of the asset management business and tweaking that balance sheet usage. But Goldman has a phenomenal franchise across all capital markets and investment banking. So again, I would leave that to equity analysts in terms of valuations, but all of those banks are doing very well.
Well, super cool to talk with you.
I wish we had more time.
Yeah, come back soon. Matt was right. Rock star. Like, it was just really interesting in terms of what we covered. Anna, thank you so much. Have a great weekend. Anna Arsov, she's co-head of global banking over at Moody's on Zoom in New York City, Matt.
All right, let's get a check on world national news now. For that, we go to Denise Pellegrini in the Bloomberg 1130 newsroom here in New York. Denise?
Hey there, thank you. Well, the date is set, as we've been reporting, for former President Donald Trump's classified documents trial. Bloomberg's Nathan Hager is tracking developments for us.
May 20th, 2024. That is the start date chosen by U.S. District Judge Aileen Cannon following a closely watched pretrial hearing this week. This means the former president's trial will begin nearly 6 months before the presidential election. It's a setback for both sides. The Justice Department had been aiming for the trial to start this December. The former president's lawyers asked for a delay until after the presidential vote. Trump is facing 37 federal counts tied to his handling of classified documents at Mar-a-Lago. In Washington, I'm Nathan Hager, Bloomberg Radio.
Thank you, Nathan. New Jersey is suing over New York City's congestion pricing plan. The proposal would charge Easy Passes drivers up to $23 to drive into the Big Apple south of 60th Street. New Jersey Governor Phil Murphy told us the plan would fall hardest on his residents.
This discriminates against New Jersey commuters. It's a huge tax on them. It frankly challenges our environment.
And Murphy commenting earlier this month on Bloomberg's Balanced Power. The suit names Transportation Department and others as defendants. And AI says it's willing to regulate itself. 7 top firms at the White House today unveiling voluntary safeguards. Bloomberg's Zach Cohen is watching that carefully.
This is both people from the major tech industries, places like Amazon, Alphabet, the owners of Google, Facebook's Meta, Microsoft, as well as some of these newer firms that are deliberately focused on creating this new artificial intelligence.
And that's Bloomberg government Zach Cohen. And live from the British Open at the Royal Liverpool Golf Club, Brian Harman, the leader now with 10 under. Second place, Tommy Fleetwood with 5 under. Global news 24 hours a day. I'm Denise Pellegrini. This is Bloomberg.
markets, headlines, and breaking news 24 hours a day at Bloomberg.com, on Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
It's 3:40 on Wall Street. We do check markets all day long. We have got NASDAQ at just about the lows of the day. 20 minutes to go ahead of the closing bell. The Dow, the S&P, they're both higher, but NASDAQ in the red. Let's head right over to the first word breaking news desk for today's afternoon call. Here he is, Bill Maloney.
And good afternoon, Charlie. That's right. U.S. stocks trading mixed in quiet trade. The Dow is currently up 22 points. S&Ps are up 4, while NASDAQ drops by 32. The U.S. 10-year yield at 3.84%. Gold is down, oil trading higher, and Bitcoin is climbing by 1.2%. Of the main 11 S&P sectors, leaders were healthcare and utilities. Industrials and telecom were under pressure. And leaders to the upside in the Dow, Intel and Procter & Gamble, while American Express fell 3.7% after earnings and led to the downside. In deal news, KKR to buy Chase Corp in a $1.3 billion deal. And after earnings, IPG fell 12%. Wrapping things up, ESPN is in talks on having the NFL and the NBA as minority investors. Live from the first breaking news desk, I'm Bill Maloney. Charlie?
Okay, we thank you very much, Bill Maloney, and to hear live breaking news over your Bloomberg type squawk, SQUA, on your Bloomberg terminal. I'm Charlie Pellet, and that is a Bloomberg Business Flash.
I'm driving in my car. I turn on the radio.
How about you let me drive?
Oh, no. Who's gonna drive you home? Honey, please, I'll do the driving. Drive on. Excuse me, I want to drive. It's the question that drives us.
This is the Drive to the Close.
That funky music will drive us till the dawn.
On Bloomberg Radio.
All right, everybody, we've got just under 18 minutes left in today's trading session, getting ready to wrap up the week and the day on this Friday, and kind of bouncing around here. We've got slight gain, as you just heard from Charlie, up on the S&P and the Dow, but call it really unchanged, call it flat if you look at the trade here. Let's get to it, though, and bring in Ryan Dietrich. He's Chief Market Strategist over at the Carson Group, and he joins us on the phone from Charlotte, North Carolina. Hey, Ryan, nice to have you back with us. Technically, what's jumping out at you when you look at the markets?
Yeah, good afternoon. Thanks for having me back.
Mm-hmm.
So you think about it, there's a lot of positive things happening, Carl. I think this week that got me, though, was banks, right? Banks, they had the earnings last week and some this week. Banks have really been strong. They've been breaking out. I mean, we all know what we've heard the first half of the year. Technology, communications has done amazing, and it's true, right? But one of our themes of our mid-year outlook that we just released at the Carson Group last week is this broadening out. And to see banks and financials in general really starting to do well, along with energy doing better, industrial doing better, it's that theme makes sense. And to see banks leading, it's just hard to think there's this big, scary recession coming that we keep hearing about. We haven't thought that. We've been in the no recession camp all year. It was quite lonely. Get a little more crowded now, but to see banks doing well is what impresses me technically here.
So the banks, we've been talking about this all day today and also the last couple of days. The valuations are extremely low. If I look at Bank America, price to book is 1 even. Goldman Sachs, I know they had a bit of a disappointing quarter, but price to book is 1.1. Why are these things, do you think, valued so poorly?
Did we lose him? All right, we lost him. Okay.
But did he hang up on us?
I think he was mad because he's actually on the phone in Cincinnati, and I think I messed up.
Oh, I thought it was Charlotte.
No.
North Carolina.
It's okay. No, he's not mad. He's a super nice guy. We're going to try and reconnect with him. But good question, right? You've been looking at this, right, in terms of bank valuations to try and understand a little bit.
Yeah, I'm just trying to wrap my head around why they're doing so badly, especially in a market that's, S&P 4,500 doesn't necessarily signal a recession coming anytime soon to me. I guess you could say that the bank stocks are being valued by the same people.
It should be close to 1, right, though? That's what you want.
More than 1.
More than 1,
One just means they're valued at the stuff they have.
All right. Yeah.
Don't they have any future at all?
So ask his question. He's a technician fundamentally, but let's see what he's back.
Is he back?
Yes, he is.
How do you know this stuff and I don't?
Because I am
all right.
clairvoyant.
Ryan, hey, sorry we lost you there. Just wondering about the bank valuations. I mean, to me, they're
and
not
we know
telling
you're
the
in
same.
Cincinnati, so sorry about that.
To me, they're not telling the same story as the overall stock market. S&P 4,500, we're up, 18% year to date? Looks fantastic. And yet the bank stocks, Goldman Sachs valued at 1.1 times book. Bank America is valued at its book.
Mm-hmm. Yeah, I mean, you think about it, that's a potential positive. Now, the banks have had the problems. We know about the inverted yield curve, some of the concerns that are out there. So that could be playing into some of it. And the truth, again, is earnings, are they spectacular? No, but we know it's all relative, right? It's just kind of where relative to expectations. I know American Express is not a bank, but you look at what American Express just said, record spending, don't see the consumer slowing down. Those things all make sense. I mean, we all know the 7 big stocks. We've heard a lot about that. If you look at the 493, take out those 7, forward 12-month earnings are like right in line with where they've been the past, 20 years. So again, yes, tech's had this big run, but other parts of the world are relatively cheap. And I'll say one final comment on this. We like small caps and mid caps. We like it a lot because we don't see a recession. Those areas are historically cheap if you go back multiple decades relative to large caps. So again, as this broadening out happens, financials, small caps, industrials, energy, they all look pretty darn good to us.
How would you play them, Ryan? Would you buy an ETF? Would you buy individual stocks? How do you play small caps and mid caps?
Yeah, we would stick with just ETFs or mutual funds. I mean, I can't do too much with individual equities anyway. But when it comes to ETFs, I think that's kind of the nicest way to play a lot of those things, especially mid caps. Mid caps are what everybody talks about, small caps and large caps. Mid caps just kind of get left, right? But again, you look at what's going on with the earnings and some of the fundamentals. There are some really solid mid cap names in there. And that's a group we're overweight, small caps and mid caps. So we're all year we're still in that camp for a second half continued catch up trade.
Hey Ryan, one thing we talk about is we're seeing increasingly economists stop talking about recession and ratcheting higher their second quarter and third quarter GDP estimates. At the same time, you see U.S. equity strategists upping their forecast for the S&P 500. They were really wrong at the beginning of the, if you go back to what they were saying at the beginning of the year. John Authors of Bloomberg News has an interesting story about all of that. Having said that,
you still got 5 more months for them to be right.
All right, but still,
Yeah.
we've gotten halfway through the year. Fundamentally, we've also talked a lot about a rolling recession, perhaps than kind of a full-on recession. Do you see any kind of fundamental or technicals playing out in the market that says that? If you look at housing versus maybe cyclicals versus discretionary, I mean, I'm just curious if you're seeing any of that.
Yeah, we're not seeing any major signs of weakness right now. You think about that, like you just mentioned, you look at equal weight discretionary relative to equal weight staples, plain and simple. Extreme strength there, which is what you tend to see when there's risk-on scenarios. Now, I'll be honest, coming into this year, we thought the S&P could gain about 15% for the year. We're one of the more bullish people out there also saying no recession, and I get it. We're right where we are. We're above, actually. The stock market's above, and we did upgrade our view on equities like a lot of other people, and we were one of the more bullish people, and you could say we still, I'd say we were wrong. We've been over at equities all year, but we're seeing just so much good things that are taking place. And you mentioned sentiment. Let's talk about sentiment just for a second here. The AAII poll, it came in over 50% bulls, the highest level since April of 2021. I took a look. When you have the first time there's 50% bulls or more, which is a lot. That's a lot. With a year without having it. So a long time, people didn't believe, then they believe. What happens next? When you look back 30 years, right, the next 6 months are higher like every single time, up close to double-digit returns on average. So just because they're starting to see some bulls finally come back, you need bulls for a bull market to take place. We're finally seeing some bulls come in, and we don't think that means this run's about to end. In fact, we think there's still a good deal left to it. But it is interesting to see so many people jumping on the bullish bandwagon here in the last couple of weeks.
I don't know. Julian Emanuel over at Evercore ISI calls it the strategist short squeeze. So basically, they were on the wrong side, and everybody's kind of ratcheting up their estimates. Ryan, thank you so much. Ryan Dietrich, he's chief market strategist over at the Carson Group, joining us on the phone in Cincinnati.
Get some Skyline chili, Ryan. Head to your local Skyline.
No, but John Authors also
you ever
talks
been to Cincinnati?
about. I don't know that I've ever been to Ohio. Maybe no.
What? You've never been to the great state of Ohio?
Gotta drive through.
How can you consider yourself an American if you haven't been to the heart of it all?
Have you been to New Jersey?
Yeah, way too many times.
Oh, you been through the airport?
No, I mean I've visited my good friend Katie Greifeld, who lives in New Jersey. I've never gotten an invite to the Masser household, but I'm almost 50. There's still time.
There's still time. All right, everybody, getting you down to the close in just a moment.
company news headlines on Bloomberg Radio.
From Bloomberg World Headquarters, I'm Charlie Pellet. Lots of tech earnings next week, including Alphabet, Microsoft, and Meta Platforms. Mandeep Singh is a senior tech analyst with Bloomberg Intelligence.
I think right now the focus is definitely on the internet names and notably Alphabet. Given, we have had a great run for all the other mega caps, Alphabet so far has somewhat missed out, and the ChatGPT overhang, you can see that on the stock. Based on the work that we have done, we've seen, YouTube trends are holding up very nicely. In fact, we think YouTube has taken share in terms of time spent on streaming platforms from the likes of Netflix.
And you can hear more of that conversation on the Bloomberg Business Week podcast. You can download it wherever you get your podcasts. Alphabet, by the way, parent of Google, will report on Tuesday. Shares of Alphabet, right now they are unchanged on the day. Microsoft, which also reports next week, down 1.7%. And also Meta Platforms, down now by just about 3.1%. Amazon plans to build a $120 million satellite processing facility in Florida to support an initiative to sell internet access from space. American Express's second quarter revenue did rise less than analysts expected as spending growth on the firm's cards slowed to the lowest level in more than 2 years. Shares of American Express down 3.6%. Those are the top company stories we are following for you at this hour. I'm Charlie Pelletin. This is Bloomberg.
This is Bloomberg Business Week with Carol Messer and Tim Stenevec on Bloomberg Radio.
All right, Matt, can you believe we're coming to the end of our run together?
Did you see the? Oh, true. Well, I'll still be around.
Oh, you're gonna come
because I'm going to be anchoring now from 10 a.m. to 1 p.m. with Paul Sweeney.
Okay. Yeah.
Also simulcast on Bloomberg Originals and YouTube or whatever.
Okay.
And then I'm going to be on TV from 1 to 2. But hopefully I'll keep joining you and Tim occasionally if you'll have me.
We would. And you'd keep doing your car thing?
I'll do the car thing for sure.
Okay.
And did you see this weed bust?
Okay. So I said to Ari, you got to do this story because Matt's going to love it. Yes.
I mean, it's a little bit sad. But apparently people have been disguising gigantic weed shipments as one shipment that was caught in Oklahoma disguised as camera equipment, another as shiitake mushrooms. When law enforcement officers cracked open the crates to look closer, they found thousands of pounds of marijuana worth tens of millions of dollars. And I saw it was the Oklahoma Bureau of Narcotics.
Oklahoma.
Yeah, Oklahoma. Bureau. Who knew they had a Bureau of Narcotics?
Anyway.
With my Surrey with the fringe on top. Apparently, so it's been heading here, right? Because New York has legalized marijuana, but they've done, I think most people would agree, a pretty terrible job of following through on it. There's only a couple of places you can legally buy it in the city.
Right.
And you can only buy certain kinds of weed made and grown in New York. So obviously, consumers want...
Getting a bit of a primer here.
Consumers want more choice, and so they bring it in from all over the place. 7,000 pounds of marijuana was seized in Oklahoma, worth $28 million. And I thought, that doesn't sound right, but it is. That's $31.80 an eighth, which makes sense.
Is that a good price? Is that a going price?
That was like the price when I was a kid, and I guess it's a reasonable black market price now. Of course, you pay a lot more in the regulated market.
Is that the wholesale price?
No, that's like on the street, $30 an eighth. Were you not in college ever? That's what an eighth cost you back then. I mean, 50 if it was kind bud, but
I am wearing Barbie pink. Barbie does not know about marijuana.
Okay, well, I'm explaining it to you now.
We're so glad you're here to do that. Anyway, I just am like obsessed with Oklahoma.
Yeah.
That's where it's coming in.
They have a hub there, a distribution hub apparently, according to the Oklahoma Bureau of Narcotics.
Oklahoma. All right, sit tight, everybody. Be on the bell. It starts right now.
Beyond the Bell, Bloomberg's comprehensive cross-platform coverage of the U.S. market close starts right now.
About 2 minutes away from the end of the trading day, Katie Greifeld and Scarlett Fu, we're counting it down to the closing bell here to help us take Beyond the Bell. It's the global simulcast. We're joined now by Carol Massar and Matt Miller. And of course, we're bringing together all of our audiences, television, radio, YouTube, and originals as we go through the crucial moments of the trading day. And Carol, looks like we're going to end on a pretty flat note.
I kind of feel like this is such a boring day. Bill Maloney was just in doing a report, and we're like, what's going on? He's like, it's just so quiet. I will say, though, the big banks, the KBW, really has had a banner week, up about 6.6% in the trade overall. So maybe what we need to do is kind of look at the week perspective a little bit.
Well, Ann, remember what you told me at the top of the program?
What did I say?
The Dow Jones Industrial Average, if it continues to be in the green, and right now it's only up 0.02%, will have finished up 10 days in a row.
I swiped that from you, Scarlett, actually. I heard you at the top.
Been talking about it all
we're just
day.
looking for anything to get us excited about a day in which the indexes have barely budged.
Oh, now it's down.
Spoke too soon. Okay.
I shouldn't have said anything.
30 seconds up. It's positive.
But you know what's interesting, though? We thought that the volume was really going to pick up here and the volatility would increase because of the expiration of options in individual stocks and indexes, and that's not really playing out, at least on the volume front or on the volatility front.
To be fair, I mean, you do have volume a little bit higher than normal, but certainly not the type of volatility that you'd expect to see, maybe that we've gotten used to on other expiry days. But about 15 seconds away from the close right now, let's take a look at the indexes. Looks like the S&P 500 is going to do it. It's going to end in the green just barely. I'll give the Dow just a couple of seconds here. You take a look at the NASDAQ composite. Tough week, down 0.2%. Of course, the NASDAQ 100 also down on the week. And you look at the Dow Jones, oh my goodness. We'll see. If it settles in the green, it'll be 10 straight days of gains. Looks like, I don't know, we're 12 seconds past 4 o'clock right now. Looks like it was able to do it.
Did you really say, oh my goodness?
Oh my goodness.
Really charming. I'm looking at the S&P 500, the breakdown for the week. Individual members, top performers. As I said, banks had quite a run this week. So Zion, Schwab, KeyCorp, Citizens Financial, Northern Trust, Bank of America, those are all a top. Morgan Stanley also there. They are all your top performers this week, Matt, in the S&P 500.
For the week, for sure. For the day, if you look at the industry groups, the economic sectors on the S&P 500, we're looking at very defensive gains. So investors bought defensive stocks like utilities, they bought healthcare stocks, they bought the energy index, real estate, consumer staples. I mean, it doesn't get any more defensive than that lineup. On the downside, you have communication services, so Netflix, which you know,
what?
I mean, I still can't get over the drop yesterday. We expect them to add 2 million subscribers, and they add 6 million subscribers, and investors sell. Anyway, you've got communication services there. You got industrials down as well as financials.
Maybe we need to think about our expectations or perspective a little bit.
To
all right.
recalibrate.
Exactly. All right, let's get to some of the individual gainers in the Friday trade. We definitely are in a Friday mode. Disney, up about 1%, up almost 2%, though, at its highs today. I think we all kind of perked up in the newsroom when there was a headline that crossed. This was coming, I believe, from CNBC, that Disney's ESPN had some preliminary talks with the NFL and NBA about partnerships and investment structures, citing unidentified people. Apparently, Disney CEO Bob Iger and also ESPN head Jimmy Pitaro have held some talks about the leagues becoming minority investors. That would be a big deal.
That would be huge.
All right, so we're keeping an eye on Disney. I want to go to chips, if you will, because Qualcomm was a top performer, number 2 in the NASDAQ 100, up about 3.3%. We saw Texas Instruments also higher, number 4 in the NASDAQ 100. Intel also a top performer. Really on the move. I didn't see any specific news, but keep in mind that you've got a couple of them reporting. Texas Instruments, Intel, NXP Semi all reporting next week. So they will definitely be on our radar. Airbnb also saw that as a standout, up about 2.5%. Morgan Stanley raising its price target to 100 from 95. Stock closing at 148 and change. It does report on August 30th. Stock's up about 75% year to date, although 7% of the float shorted. And just a real quickie, if I may, Service First Bank shares, Alabama-based bank, about $3.1 billion market cap, up 20%, soaring. As the bank said, deposits grew by 23% on an annualized basis. Stock, though, down about 16% year to date, guys.
All right, let's take a look at some of the decliners here. And we're going to start in the communication services space with Interpublic, the advertising company, cutting its full-year forecast in half after a pullback from tech lines. So it's now looking for growth of 1 to 2%. That stock down 13%, also taking down Omnicom with it. American Express was the worst performer in the Dow Industrials, which, by the way, guys, looks like it did eke out a gain so far, 3 minutes in. Well, that streak is alive. Anyway, American Express second quarter revenue rose less than expected as spending growth on its credit cards slowed down to a 2-year low. And Schlumberger, I can't figure out whether it's now SLB or Schlumberger.
Schlumberger.
Okay,
Schlumberger.
Schlumberger.
I've been saying Schlumberger.
Schlumberger.
Schlumberger, really?
No, it's Schlumberger.
Okay.
We're messing with you.
You're making me question myself. It is the world's biggest oil services provider, and activity in North America will fall this quarter as a slowdown in U.S. shale puts a drag on growth in its overseas operations. And Intuitive Surgical, this is an interesting one. It fell as much as 5.2%, so it had a second quarter earnings beat, but investors are focused on a continued decline in bariatric surgery in the U.S., you know, the stomach stapling surgery. Apparently, weight loss drugs have become an attractive alternative, so fewer people are getting the surgery because they're taking, what is it called, Ozempic?
Yeah, probably better than getting your stomach cut open.
Yeah.
What's the other one? Wegovy? Is it
Something
Wegovy?
like
Wegovy and Ozempic.
Wegovy.
Yeah, so no more stomach surgery.
I'm in the market.
Ozempic.
It's the cover story of Bloomberg Business Week, by the way, because WW betting big on these weight loss drugs.
WW. It's called Weight Watchers.
You know,
SLB.
But we're never
Weyerhaeuser.
going to say WW because people are like, WWE.
No one knows
like,
what it
are you
is.
It
talking
doesn't make
about?
any sense. There are a couple of rebrandings, EY and WW, that are simply ridiculous.
Remember when it was Apple Computer and not Apple Inc.?
But but like, it's like, you know, these companies that we constantly like are formerly known as Alphabet, Google, same thing.
Yeah.
Well,
Elevance.
have we not brought up Meta?
Oh, yeah. The biggest one of them all, right?
Yeah. But let's talk about the bond market, you guys, which has never been rebranded. We're talking about the full faith and credit of the United States. You look at the 2-year yield. I'm going to call that unchanged, really unchanged across the curve, of course. We know that the Fed is meeting next week. We know that they're probably going to hike.
There's a Fed meeting next week?
There's a Fed meeting next week. There's an ECB meeting next week. There's a BOJ meeting next week. I'm psyched. But you look at the tape today.
And 40% of the S&P 500 reporting earnings next week.
That's
But we're talking about the bond market right now.
Okay.
So in any case, you add it all together, you did get a little bit of a deepening of the inversion of the 2s, 10s curve. We're back below 100 basis points of inversion, but really interesting conversation I had earlier today on real yield about what message that actually sends. Bank of America and PIMCO are of the mind that actually...
Was it really interesting?
It was really interesting, Carol. I hope you were watching.
I actually always listen to you when you do it.
Really?
I have like, you know, multitasking.
Wow, you and my parents.
If it's not steepening, by the way, Katie, is it always flattening or is it inverting more?
I think it's fair to say it's inverting deeper because the flattening, we already did it, you know. We're below zero, but maybe...
No, but you talked about, right? Your guest was talking about the significance of what it really says.
They see it as basically an endorsement of the Fed's policy, that the bond market is believing that the Fed is going to get inflation under control. That's the signal to take from that yield curve inversion versus recession signaling.
It only took a year for everyone to get on board.
Yeah.
Well,
do we think we're really on board? Do we think that the bond market's on board?
This is why I keep thinking about like all of these revisions, I feel like, in strategists and economists, and I get a little nervous when all of a sudden everybody, you know, it's like a seesaw. Like all of a sudden everybody's running to the other side, or, you know, a yacht or something, or a boat. Like everybody's going to run to the other side, and it's wrong. Like, I don't know. Is it just getting too optimistic, or is it, as you said, I think earlier, Katie, about this whole idea of a soft recession, right, or soft landing, right, that it's not so predictable, and it takes a while to work its way there.
It's a really big, complex economy. Maybe there's recessions in certain parts of the economy.
Rolling recession, a rich session.
Rich session.
Is another one I've heard recently.
What does that mean?
It's bad for some people and not bad for others, basically.
So the rich are in recession?
That's what that term means if you buy into it.
Oh, interesting.
The rich are in recession?
Usually the rich are not in recession.
That's
okay,
right.
Really important. Who's going to go see the Barbie movie?
Not this weekend, but it's...
I'm holding off for a weekend.
Yeah.
Don't you love
I'm
it?
the only one? I'm the only one?
The guy is going to see the Barbie movie.
You have a daughter, so she's excited,
she's
right?
2.5. She's not coming with me. We're getting a sitter, and I'm taking my wife.
It is PG-13, you know.
Or actually, my wife is taking me.
Okay.
I don't want to sound sexist.
All right.
I get it.
That's a wrap. A lot going on next week. Guys, have a great weekend.
Rest up for a big week next week.
Woohoo! All right, that's going to do it. Our wrap, our cross-platform coverage, radio, TV, YouTube, and Bloomberg Originals. We call it Beyond the Bell. We will see you again on Monday. right, no easy segue. We're having fun with Barbie and other stuff, but now we got to get serious again because we've got to talk a little bit about what's going on in terms of our environment, because it's already being billed as the hottest year on record as excessive heat warnings and advisories stretch across the U.S. from Washington State and the western U.S. to Florida. The hot temps can be super dangerous. We know that. They come with an economic impact, some good, some bad. And of course, Matt, there's really that little existential threat that it really poses to our world. I mean, it's serious.
Yeah, no, absolutely very serious.
All right, so let's get to it. With us is Bloomberg Intelligence Senior ESG Climate Analyst Andrew John Stevenson in our Washington, D.C. bureau, along with Bloomberg News Sustainability Editor, Eric Roston, with us on Zoom in New York City. And first of all, Eric, lay it out for us. I keep reading a lot of things. You know, here we are. It's July 21st, a few months to go. But I keep reading stories about this is going to be the hottest year on record. It's a global story.
And it's not just about heat, right?
No.
I mean, Eric, we were talking to you about
Extremes.
the lasting damages that wildfires, I think in that case it was Australia, have left on communities and families. You know, it's not just about a hot day. It's real damage.
It's real damage, and as long as fossil fuel emissions continue at anything like the rate they have been, climate change will always be in its opening act. We're seeing everything you said, you know, temperatures, there are unprecedented heat waves on 3 continents across the northern hemisphere. Northwestern China set a new record for above 40 degrees north latitude at 126 degrees Fahrenheit. Phoenix, as you can see, is up to, I think, 21 days in a row with temperatures above 110 degrees. So, you know, the scientist, Gavin Schmidt, who's the head of NASA's climate unit, you know, likes to say that this is shocking but not surprising. That's where we are. We've known about this for 60 years.
Andrew, come on in on the conversation. You obviously study climate from, I guess, analysis, impact, economic impact, financial impact. What is it that you are seeing?
Another, horrible year, really. We were talking a little bit about the impact of the smoke. About a third now of our air pollution now is coming from smoke, from wildfire smoke. So this is a pretty significant contributor to a lot of health issues, lost wages. There's estimates it's up to about $150 billion a year in lost wages because of people having to stay inside or, not doing as much because of wildfire smoke, which is pretty significant. The work that we were rolling out today really looks at, doesn't look at smoke, but it looks at all the kind of physical wealth and the economic impacts that we're seeing from climate change. And if it's a pretty big analysis, it goes state by state and looks at really the cost if you think about climate change as just a giant wealth transfer, which is what we're seeing in the order of about $500 billion a year. These are storms that are taking place, obviously very large and impactful in terms of the damages, the insurance, the insured and uninsured portions of that, as well as federal spending related to climate. We have power outages. We have, significant other crop-related damages as well. If you roll all these damages up, which we've done on the terminal, it looks to be about $500 billion a year over the last 5 years on average. If you think about it, it's a serious wealth transfer within the economy. It's almost a standalone piece of the economy. It's bigger than the utility sector as a percentage of U.S. GDP at the moment, running around 2%. The data that we have on the terminal shows it from, at the state level as a percentage of GDP. We've seen it for the country running between sort of 2 and 4% of U.S. GDP over the past several years. So it's an economic player. It's becoming very much a real and present part of our economy, and you're seeing a lot of money changing hands between companies.
And the horrible thing about the smoke, I mean, I still can never forget on the Australia story that Eric did is how it damaged children's lungs. So that's permanent damage in some cases, for the rest of their lives. And I shudder to think of the damage that's done to, infants and children here or, anywhere that this Canadian wildfire smoke has also rolled down to. It's really depressing, Eric, but you actually have a story on 3 books that won't bum you out. So I guess what is this actionable stuff that we can do,
Please tell us it's not too late.
Yeah.
Yeah, I feel like it's definitely not too late. It's always been a challenge to talk about climate change, but right now, like the bifurcation, like the cognitive gymnastics you need to do to get a handle on climate change. So like everything I said at the top of the chat is true. It's also true that we have a better chance of solving this problem now than we ever have had before. Let's say policymakers in the late 80s and early 90s had said, this is our number one priority. We're going to get on this early and fix everything. Like they couldn't have done it because they don't have the tools we have today. Renewable energy, EVs, all these things are very real. They have already shaved 8 gigatons a year off of annual emissions, deployment of clean energy and other
Is that
factors.
a lot? Help me out. What's 8 gigatons in regard,
Yeah, that's about 1/6 of global emissions.
Okay, keep going. Yeah.
So we've already shaved off like 1/6 of would-be emissions because of the energy transition. So to your point, so today I had a short book review run on 3 new books that what's pleasing about them is it's like the first one it's a very well-researched book called The Parrot in the Igloo by NYU instructor and writer named David Lipsky. And he goes through kind of the history of climate science, but not only that, the history of public debates about climate change. And he really does a good job with the narrative that cooks about the entrance of professional science denial, about how people went from working on tobacco and cancer denial to working on fossil fuel climate change denial, stuff that's still in effect today. 2 other great books, one on ice by Dr. Amy Brady, which is just a lovely, perfect summertime read on Americans' obsession with ice, culturally and commercially. And the third one is Not Too Late, a hopeful book on how to think about the challenge ahead.
I love this. This is like great summer reads.
Very cool. I recommend people check it out on the terminal. You can just bio Eric Roston and find his story. Andrew, let me ask you about something that Carol and I hear about a lot and talk about a lot and are kind of skeptical of or excited about, depending. Carbon credits, offsetting your big carbon footprint by buying carbon credits, or, pushing carbon back into the earth, sequestering carbon, or planting trees in order to offset your carbon footprint. Does any of this stuff helpful, do you think?
Well, the carbon credits are obviously, you're kind of passing the buck, right, to future generations to figure the problem out. You're kind of abdicating your, it'd be better if you tried to figure out how to reduce the amount of emissions you're producing yourself rather than just sort of buying it from a third party. So some of them are obviously at risk when you're talking about wildfires and forestry. Those things, you could be breathing them right now from Canada. In some cases. So you do need to be very careful about those things. You do mention sequestration. That will actually be a pretty important thing. I mean, we've spent a lot of time especially in the Permian, drilling holes in the ground, pumping CO2 into the ground to try to flush out oil. And we've always lost CO2 in the ground as we kind of recycle that CO2. So we do know that it works. You can actually put it, if you put it deep enough in the ground, it kind of, the gravity underneath the ground sort of helps it stay where it is. And so this is something that has some benefit, and the policies that we've seen in the IRA are really trying to push people forward with that. And that's why you saw Exxon this week buy Denbury. They see this as being a winner for them because the subsidies are decent. It really works across not just the oil and gas industry, but steel, cement, other industries along those lines can actually take advantage of sequestering their carbon in the ground by pumping it into the ground.
All right,
Nice.
we're going to continue to talk about this. You guys, thank you so much. Andrew John Stevenson, Senior ESG Analyst over at Bloomberg Intelligence, and of course, Eric Roston, our Sustainability Editor at Bloomberg News. Check out the books he just talked about. This is Bloomberg.
markets, headlines, and breaking news 24 hours a day at Bloomberg.com, on Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
It's 4:21 on Wall Street. We do check markets all day long here at Bloomberg. The Dow, the S&P higher today. We had NASDAQ lower on the week. The S&P 500 index up 0.7%, second weekly gain in a row. The Dow on the week rallied 2.1%. Today, the Dow was up 2.5 points. Little change there, up less than 0.1%. NASDAQ, however, had a losing week, falling by 0.6%. Today, NASDAQ slumped 30 points, falling by 0.2%. Again, the S&P a little change higher today by just 1 point. 10-year yield 3.83% with a 2-year 4.84%. Spot gold down $7 the ounce to $19.61, down just about 0.4%. West Texas Intermediate crude up 1.6%, $76.88 a barrel. Former Treasury Secretary Larry Summers is warning that the Biden administration's crackdown on mergers and acquisitions through a sweeping overhaul of rules the government uses to determine whether deals violate competition law, quote, seems almost like a war on business. He spoke with our David Weston.
I wish that this stepping back and offering merger guidelines had been taken as an opportunity to rationalize the policy and step back rather than to double down on what sometimes seems almost like a war on business.
And to hear the full interview with Larry Summers, tune into Bloomberg Wall Street Week tonight, 6 p.m., right here on Bloomberg Radio. Again, recapping mixed day on Wall Street. S&P little changed up today by 1 point. I'm Charlie Pelleton. That is a Bloomberg Business Flash.
All right, Charlie, thank you so much. Well, been looking at Bitcoin. Mr. Bitcoin.
Those people over at Bitcoin.
It did reach a fresh high for the year earlier this month, but we've seen maybe it kind of settle into a range because we have a great story on the Bloomberg that talks about the momentum may be not sustainable because you've got prices stuck in a very
tell
narrow
you
range.
what. The journalists here are so desperate to call the demise of Bitcoin. I mean,
maybe they're just
it's
reporting
trading
on
for
the trading activity.
$30,000. I bought one for $600.
Okay, but that's how many years ago?
10 years ago.
All right.
What else has gone from 600 to 30,000 in 10 years?
Okay, fine. How come you're still working then if it went that high?
No, because I only bought one.
Oh, okay. Anyway, we want to talk a little bit about the world of crypto because we've had some court rulings that some have said is positive. We've definitely seen some of the traditional finance guys continue to kind of up their bets, it looks like, and moving into the space. So let's get into it with Rob Fresca. He's co-founder and managing partner at the investment firm Cosimo Ventures. They invest in digital assets and blockchain companies. He's on Zoom in Boston. Hey, welcome back. How are you?
To be here.
As
always, Friday afternoon.
Is Matt right? What other investment
Rob,
has done so well?
You know what, Rob? I feel like we're just, I think the crypto community has set expectations way too high because I always hear journalists poo-pooing crypto since it hasn't completely taken over the global financial system yet in 10 years.
There you go. Well, you know, some people could say we're in the trough of despair right now, right? You know that bubble cycle where, you know, the bubble pops and then everything kind of comes down and then all of a sudden everything goes to the moon again. I think we're in that kind of trough of despair right now, but there's a lot of really interesting stuff going on.
Well, you had BlackRock filing an application for an ETF, among others. I mean, like, who hasn't filed an application
for a
Bitcoin ETF yet? And you had Larry Fink, you know, hater of crypto, champion of ESG, go on Fox Business News and say, we need to tokenize more assets. I mean, if that doesn't tell you something, I don't know what does.
Yeah, look, I'll tell you. So I've been in this market now since 2014. We've been investing in blockchain. And I'll tell you what I think is going on right now in the U.S. is kind of, I call it the great trad fire, the great traditional finance takeover, right? So when you see the SEC, right, they're coming down on different projects, coming on lack of regulation. And by the way, the rest of the world has regulation. But when you see that happen, in the big pullback. And then all of a sudden, Ripple wins their case, Library wins their case, and then BlackRock comes out with an ETF. Look, BlackRock doesn't do anything unless they kind of know where it's going to go, right? So there's some interesting things kind of packed up in this. One of the things that's important to understand about BlackRock in this ETF is, number one, Coinbase is doing the custody for it. Okay. Number two, more importantly, NASDAQ is doing the surveillance on it. And that is the key, right? Because the SEC is worried about market manipulation when it comes to crypto. And so
rightfully so.
Right. And rightfully so. Right. Exactly. And so now I don't know if you guys heard the CEO of NASDAQ, right? And they have this custody product for crypto. And I always kind of shook my head and said, why are they doing that, right? Because NASDAQ has two businesses. They have exchange business and they have a software business that's really about surveillance, risk management, fraud detection, all of that kind of thing. So why would they be building a custodian? And so recently in their earnings announcement, she said, look, we're going to put a hold on that custody business. And everybody went crazy. Oh my God, what does that mean? I'll tell you what it means. What the U.S. wants is they want the exchanges and the custodians to be separate. And so if you look, Fidelity, right? And Charles Schwab and Citadel, what do? They just launched an EDX, a new crypto exchange. The most important word in that sentence is non-custodial exchanges. So I think, when you look at how this is playing out, you've got the big guys coming in with ETF products. You've got proper surveillance being put in place with NASDAQ. And then you've got bigger players coming into the exchange business in a non-custodial way. So I really think, what's that saying, right, with Warren Buffett, right? Be fearful when others are greedy, be greedy when others are fearful.
Yeah.
Man,
I think it was Benjamin Graham.
What is it?
Yeah, no, you're right. Buffett
right,
just read Graham's book.
Warren Buffett, right?
Yeah.
I just think, look, there's a lot of fear, but when you got these big traditional finance players coming in, and they are telegraphing the market, to say, look, the way that these exchanges need to work are non-custodial. And then NASDAQ is coming in doing surveillance, right? So anyways, I'm excited about this because, as an investor, I sit back. I mean, what's Kathy Wood? What's her prediction on? Let me look it up here.
1.58 million.
Yeah, about 1.5, 1.4.
Yeah, 1.4 by 2030. Don't forget, right? Don't forget this. There's only a limited supply of Bitcoin,
Yeah. Well, and by the way,
BlackRock comes in.
Our David Weston caught up with Adina Friedman, who's the CEO, NASDAQ president and CEO, and they talked specifically about that. So anybody who wants to hear a little bit more about it directly from her can check it out on the Bloomberg or at Bloomberg.com. Having said that, Rob, you play in the blockchain space, right? Largely or predominantly or only. Why?
Well, look, so I'm a .com entrepreneur. I actually started the very first financial service on the internet, first stock quote server. I'm talking 1993. Quicken bought it. It wound up becoming Quicken Financial Network. I did one of the world's first AI companies out of Carnegie Mellon with our CTO. We sold it to Lycos, took that public. So I've been in this market for a while. And when blockchain emerged, what I immediately realized is that this is the piece of the internet that's been missing, and what that is basically that peer-to-peer, networked, decentralized kind of trust layer that everybody needs. The ability to clear transactions peer-to-peer in a trustful way and in a resilient way. It's kind of a geeky way, right? It's my Carnegie Mellon kind of bastion a geekery way. So for me, I think blockchain is probably, I'm going to put a little hyperbole here. Probably, I think there's going to be more value created there than the internet itself, because it's the value layer of the internet. So anyway, I'm all in on blockchain, all in.
So what are you actually doing in the space? You have VC investments, and they're tokenized?
Yeah, so we have a venture fund that invests in the space, And being pioneers that we are, we decided to tokenize it. And we were the second VC fund to do that. I think we're the only evergreen VC fund to do that. We use Securitize, who now is doing KKR and a bunch of others. So we really became, and we did that to really become experts in this space. We were so early. We didn't think, liquidity was going to fall out of the sky, right? In my opinion, it's still early. But we wanted to know the market. So we tokenized it. And what that fund does is invest in all kinds of early stage, illiquid generally, blockchain assets, from the networks to Web3 to the infrastructure to the tokenization platforms across the board. And then we have a hedge fund that we're now launching, which is actually a risk managed fund. And it's all proof of stake digital assets. So there's actually the ability to generate a yield while hedging to the market with alpha.
All right. Got to leave it on that note. What, Matt?
I'm just thinking, I wonder if Gary Gensler is going to come knocking on your door anytime soon.
Where are you based?
We'll leave that for another time.
Everything we do is, is SEC regulated, right?
Right.
So, we're not the project, we're the investors.
All right. Rob, have a good weekend. Rob Frasca, he's managing partner at Cosimo Ventures from Boston. Let's get to world and national news. Off to Denise Pellegrini in the newsroom. Hey, Denise.
Hey there. Isn't that how we find out if Gary Gensler is listening to your show?
Exactly.
Of course he's listening.
Exactly. And he'll also want to know, of course, that New Jersey has now filed a federal lawsuit over New York City's congestion pricing plan. Bloomberg's Nathan Hager is tracking those developments. He has more for us now.
The case names the U.S. Department of Transportation and the Federal Highway Administration as defendants. New Jersey Governor Phil Murphy has said drivers in his state would be unfairly burdened by the plan to charge Easy Pass drivers up to $23 to enter the city south of 60th Street. The tolls are expected to help raise $15 billion for public transportation projects in New York City. Officials there say it could also cut downtown traffic by 20%. In Washington, I'm Nathan Hager, Bloomberg Radio.
All right, thank you, Nathan. Also, we're watching how executives from Amazon, Google, Microsoft, and others went to the White House today. President Biden says, as we've been reporting, the companies are pledging to protect the public, including labeling content that has been altered or AI generated.
Today, I'm pleased to announce that these 7 companies have agreed to voluntary commitments for responsible innovation.
And President Biden speaking there at the White House. The president, by the way, has also chosen Admiral Lisa Franchetti to lead the Navy. That's according to a senior administration official. If confirmed, she would be the first woman to be a U.S. military service chief. Donald Trump's classified documents trial is now set for May 20th of next year. And live from the British Open at the Royal Liverpool Golf Club, we have Brian Harman, the leader now, with 10 under. In second place, we have Tommy Fleetwood with 5 under now. Global News, 24 hours a day. I'm Denise Pellegrini. This is Bloomberg.
Markets, headlines, and breaking news 24 hours a day at Bloomberg.com, on Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
It's 4:40 on Wall Street. We do check markets all day long at Bloomberg. The Dow, the S&P higher, little change today. NASDAQ and the NASDAQ 100 index declined. Russell 2000 also moved lower. We begin with the S&P up 1 point. It was an up week for the S&P 500 index, 2 in a row. S&P today, as I mentioned, ending the week at 4536. The Dow today higher by 2 points, and as we head into the weekend, NASDAQ fell 30, down 0.2%. NASDAQ 100 index down 40 points today, a drop of 0.3%. The Russell 2000 down 6 points, a drop there of 0.4%. Bottom line here, tech shares continued their sell-off as investors look to earnings in the week ahead after a disappointing batch of results earlier this week. 10-year yield 3.83%, the 2-year 4.84%. Spot gold down $7 the ounce to $19.61. West Texas Intermediate crude up 1.7% today, $76.94 a barrel. Ryan Dietrich is chief market strategist at the Carson Group, and right here on Bloomberg Business Week, he told us that bank leadership is a positive.
To see banks and financials in general really starting to do well, along with energy doing better, industrial doing better, it's that theme makes sense. And to see banks leading, it's just hard to think there's this big, scary recession coming that we keep hearing about. We haven't thought that. We've been in the no recession camp all year. It's quite lonely. Get a little more crowded now, but to see banks doing well is what impresses me technically here.
And you can hear more of that conversation on the Bloomberg Business Week podcast. You can download it wherever you get your podcasts. After earnings, AutoNation shares plunged 12.3% today. After earnings, New York-based American Express down 3.9%. I'm Charlie Pelleton. That is a Bloomberg Business Flash.
All right, Charlie, thank you so much. Well, Carol Massar, along with Matthew Miller. Matt, of course, in for Tim here on Bloomberg Business Week. New issue, by the way, of the magazine. It's out on the cover, story about Weight Watchers, company known now as WW. It's going to always be like that.
Yeah, it's so silly. It's Weight Watchers.
All right, well, it's WW, but anyway. The story's about its last shot, perhaps, in terms of strategy by embracing the wonder diet drugs of Wegovy and Ozempic. Those drugs we've been all talking about it, the world has been making headlines because of their use among celebrities and influencers because they make you lose a lot of weight. They're expensive, but we really wanted to get a medical view on them. So great to have back with us is Dr. Ian Lospater, clinical professor of medicine at NYU Langone Medical Center on Zoom in New York City. How are you? How's your summer going?
Great. Thanks, Carol, Matt. Great to see you.
Yeah.
Summer's going great. Scuba diving, it's been fun.
Where'd you go scuba diving?
Bermuda, which is quite beautiful, actually. Great coral reefs in the middle of the Atlantic. Who would have guessed?
You're not talking.
That's fantastic.
You're talking to two divers. I've never gone diving at Bermuda. Really beautiful?
Yeah. 40 feet, there's a shelf, a bit of a continental shelf there. Great coral, a few wrecks from the 1800s.
Very cool.
That's fantastic.
All right. We're going to switch gears, though, because we do want to talk to you.
I especially have questions because I want to use this stuff.
He does.
So Doc, I got to say, have real trouble keeping off the pounds. I need to lose at least 20 pounds. And the issue is I get home at night after a long day at work, and after dinner, I grab the Haagen-Dazs. And I just can't stop myself from doing it. Now, I realize it's my weak will that's the issue, but I hope that if I could get a hold of just a little bit of Ozempic, that could solve the problem.
Well, you and a lot of people, it's become very popular. But, why do we care about weight and obesity? It's really more than just appearance. And obviously, over the ages, appearance standards have changed. In the 17 and 1800s, being more overweight was attractive. Now we realize, it's more attractive to be thinner. But it's also, there are really serious health risks associated with obesity. The concern, of course, is 40% of Americans are obese, 2/3 are overweight. And we really define that as a BMI, or body mass index, which is a calculation based on height and weight. So people whose weight is too big for their height have an elevated BMI. And really over 25 BMI is overweight and over 30 is obese. But who cares? The reason is we see a much higher incidence of type 2 diabetes, fatty liver, sleep apnea, heart disease, sudden death, cancers, increased risk of breast cancer, colon cancer, liver cancer. So it's not just appearance. We really want to get weight to a more ideal level to reduce the risks. And in fact, we really do reduce morbidity and mortality when we get the weight down. It's also a cost issue. Over $260 billion a year is spent on obesity-related issues. That includes medical costs, lost work, disability. The question is, how do you do it? How do you get the weight down? And really, in the old days, it was like, well, just eat less calories and burn more calories.
Duh.
But we now know it's more complicated. There are genetic...
Is it really more complicated than that for most people, Doc? Because when I do want to lose weight, all I do is eat healthy and exercise. And guess what? The pounds fall off.
Matt keeps saying, Ian, he keeps being like, you just got to be strong and not eat. And he's like, it's just you can control this. Help
Which
us.
is true.
Yes, that for many patients, but many patients, based on their genetics, based on food density, people eat burgers and so forth, the fast food, which is a higher calorie density.
Well, you can't do that.
You can't do that.
You got to eat fruits and vegetables and exercise, right?
Yes, that is absolutely true. But for those people who can't do that, whether it's discipline or other issues, there are a whole host of medications. In the old days, we would do like some fat blockers and diabetes meds. But as researchers began to look at various meds for diabetes, type 2 diabetes, they found these GLP-1 agonists, which work on receptors in the brain and the gut. And dulaglutide, semaglutide, liraglutide, all of these things are, for example, like Wegovy or Ozempic is one generation. We have some newer ones called tirzepatide, made by Lilly or Mounjaro. All of these medications work both at the brain to suppress appetite, which is very effective, also in the gut. It slows motility, the stomach empties slower, you feel more full, but you can also get some complications from that. Nausea, heartburn, sometimes vomiting, constipation, but occasionally even more serious things like pancreatitis or gallbladder issues, very, very rare thyroid issues. So you really need to be screened. Are you appropriate? And it's also cost. Insurance, these are very expensive because they're all on patent, no generics. So insurance does not want to pay for it for casual weight loss. You really need to meet certain criteria. For example, like diabetes. Some insurance companies will pay for obesity, but most private insurance really insists that you have type 2 diabetes. And there are some patients who are obese, but their sugars are okay.
Hey, can I ask you something? And this is going to go into the woke world. Because I do feel like over the years, there's been pressure to embrace, especially for kids, when kids or just individuals are overweight.
Everybody's so fat because they all eat crappy food.
Stop.
Okay.
To be more welcoming. But there are health implications of being overweight. I can't tell you how many times like a doctor's like, I'm so glad,
He just went through the list of things that could happen.
I know. So, but how do you balance that, right? Because we're supposed to be more accepting of variations in individuals. But from a medical perspective, it's not healthy.
Yeah, no, you can't be accepting. I mean, of course, people have various issues and orientations. But when it comes to weight, diabetes, fatty liver, liver disease, it's not okay to say, well, that's just, how you want to be. We know medically this is unhealthy. It increases the risk of complications and early death. And for patients who want to work with a doctor, we do have various approaches. Now, how long you have to stay on it, or the risks of the medications, we went over those. And also the patients who do lose weight, and we do see a lot of patients lose 30, 40, 50 pounds, eat 10% of their body mass, which is great. How long did they have to stay on it? Can they taper off? There are really a lot of questions, not to mention the cost of the medications. I wish it was so easy as diet and exercise.
Yeah.
Just be disciplined. That works for some people, but often not. And the ability to come in and say, you know what, I'm on medication, I'm just not hungry, I feel full, and I've lost weight is a very nice
Gotta run. Ian, thank you. We never have enough time with you. Dr. Ian Lustbader of NYU Langone.
your company news headlines on Bloomberg Radio.
From Bloomberg World Headquarters, I'm Charlie Pellet. UPS and Teamsters negotiators are poised to restart talks on July 25th as the two sides seek an agreement before the current labor contract expires at the end of the month. A spokeswoman for the Teamsters says those talks will resume on Tuesday. The two sides had previously said they would return to the bargaining table next week without providing a specific date. Shares of UPS today, they advanced 0.2%. Rival FedEx lower by 1.5%. American Express's second quarter revenue rose less than analysts expected as spending growth on the firm's cards slowed to the lowest level in more than 2 years. More from Bloomberg's Jeff Bellinger.
Charlie, volume on the Amex network increased 8%, the weakest gain since the first quarter of 2021 and a smaller increase than analysts anticipated. Revenue also fell short of estimates. Amex is facing tough comparisons to recent quarters, which included bigger increases in travel and entertainment spending as consumers freed from pandemic-era restrictions flocked to international and domestic travel destinations. Amex said travel and entertainment spending jumped 14% in the quarter. Restaurants are now the biggest component in that spending category, with Amex consumers spending more on dining out than they do on airlines or hotel stays. Charlie?
And that's Jeff Bellinger reporting. Shares of American Express down today by 3.9%. Also reporting today, AutoNation, that stock plunged 12.3%. Those are our top company stories. This is Bloomberg.
You're listening to Bloomberg Business Week with Carol Messer and Tim Stenovec on Bloomberg Radio.
All right, everybody, you are listening and watching Bloomberg Business Week on this Friday on Bloomberg Radio, on YouTube, and of course on Bloomberg Originals. Carol Messer along with Matthew Miller in for Tim Stenovec. Hey, coming up, we've got our weekend show, and it's quite a lineup.
Yeah. What have we got? I know, is Jessie on the weekend show?
Yeah, we're
Jessie Draper.
We're going to get to that in just a moment. She is on the weekend show. First up, though, we do want to get a check on world and national news. Off to Denise Pellegrini we go. Hey, Denise.
Hey, guys. Thank you. Leading AI companies are publicly committing to a pledge now to responsibly develop and deploy the technology that could protect people against AI. Bloomberg's Amy Morris reporting from our Bloomberg 99.1 newsroom in Washington.
The White House had warned Microsoft, Google, and OpenAI that they must ensure the technology doesn't lead to harm. But these commitments are voluntary. There's really only so much the White House can do to steer the most advanced models away from potential misuse. The White House says the agreement will expire once Congress passes a bill, but lawmakers have been holding information sessions for months and might never find consensus on binding legislation, and that leaves the companies, for now, to police themselves. In Washington, I'm Amy Morris, Bloomberg Daybreak.
Thank you, Amy. Donald Trump's classified documents trial is now set for May 20th of next year. That's potentially before the GOP nominee he is hoping to be is decided. New Jersey suing the Federal Highway Administration over the new MTA's congestion pricing plan, and Representative Josh Gottheimer says this plan will bring no positive change to his state.
Not a nickel will go to Jersey to invest in our mass transit. Not a nickel to address the environmental and health impacts.
And Gottheimer also says it will cost drivers entering Manhattan from New Jersey as much as $23 during rush hour, $17 during off hours. That's if they drive all the way down to or up to below 60th Street. Watch for more shortages of ADHD and cancer medications. A tornado has struck a major Pfizer facility in North Carolina. This will affect the availability of medicines, according to healthcare service providers Premier and Vizient. They're working with other drug makers to see who can ramp up production. And even before this tornado, hundreds of medicines were in short supply. And live from the British Open at the Royal Liverpool Golf Club, we have Brian Harman, the leader, 10 under. In second place, Tommy Fleetwood with 5 under. And
I left my heart.
Yeah, the tributes are pouring in now for Tony Bennett. Elton John calling him irreplaceable in an Instagram post. Steve Van Zandt posting on Twitter his heart was as big as his voice. The Reverend Jesse Jackson noting Bennett's dedication to doing good. Tony Bennett died today, just 2 weeks shy of his 97th birthday. Global news 24 hours a day, powered by more than 2,700 journalists and analysts in over 120 countries. I'm Denise Pellegrini, and this is Bloomberg. Carol, Matt, back over to you guys.
All right, Denise, thank you so much. We mentioned our weekend show coming up. ARK Invest founder, CEO Kathy Wood was with us, and among the topics, car costs and broader inflation. Check it out.
If you remember during the early stage of COVID and the supply shocks, at one point, the combination of used cars and new cars accounted for a third of the increase in inflation. I think you'll see that on the downside here. And we're going to get to 2% inflation, I think, much faster than many people think, with perhaps a harder landing, more for corporate margins than anything else. Because if you see these discounting and you see consumers respond to discounting,